Welcome back to the Capital 10X interview series. The explosion in sales of electric vehicles has created a once-in-a-generation investment opportunity in the battery metal space. Specifically, we see demand for copper, lithium, nickel, potentially exceeding supply for the rest of this decade at least. In today's interview focused on copper, you're going to hear from the leader of one of the most unique companies in the copper industry. I'm pleased to be joined by Aurora Davidson, CEO of Amerigo Resources. Aurora, for anyone listening who doesn't know Amerigo, could you give us a brief outline of your assets and how your exposure to copper is truly unique among publicly traded companies?
Sure. Happy to do that. Look, Amerigo is unique, as you were saying, because we produce copper, but we don't have a copper mine. Our source of material is essentially the waste mined material from the world's largest underground copper mine, which is located in Chile and is called Codelco. We have a company in Chile called MVC, and MVC has been producing copper from this waste material for the last 30 years.
What are the most important metrics you think investors should watch to better understand Amerigo's operations?
I think that there are two key business success drivers that are under our control that I want to touch on. One of them is for us to have consistent and reliable copper production. The other one is to achieve that production at our target cost. So those are the two success variables that we control, and we're good at doing that. When you layer a strong copper price on top of that, then you essentially have a company that can generate a substantial amount of operating cash flow. Now, the other driver to understand is that Amerigo does not have a substantial amount of sustaining capital expenditure requirements, CapEx requirements. We have low CapEx, and we have a very manageable debt level. So the operating cash flow that we generate essentially translates almost instantaneously into free cash flow to equity, free cash flow to our shareholders.
Aurora, now that you've been guiding the company in one capacity or another for 20 years, which is really impressive, can you tell us what your overall objective is for the company? What do you want Amerigo to offer investors?
We're in a sweet spot right now. It has taken us 20 years to get to this sweet spot. We did a major plant expansion to get us to the production levels that we currently have. So we are at that a stage of achievement that a lot of companies want to get at some point in time. So our objective essentially is to continue to deliver, to not get distracted, to not get complacent, and to consistently meet our goals. If we continue to do that, essentially what we're offering our shareholders is a company with a high dividend yield that presents a unique investment opportunity within their portfolios.
Amerigo's dividend yield, currently above 8%, is extremely attractive and looks well supported at significantly lower copper prices than today. How do you judge when the time is right to raise the dividend, pay an extra performance dividend, or buy back shares? Take us through your thought process.
Sure, that's a bit of an art and a science. But in reality, the board of directors wanted to come up with a capital return policy that was simple, not overly complicated, and at the same time flexible enough to let us navigate through the changes in copper price that occur from quarter to quarter. So in order to do that, we determined that there were three tools that we needed to use. The first one is the regular dividend. And we started out paying a quarterly regular dividend of 2 cents per share. It's now up to 3 cents Canadian per share per quarter. What do we want to achieve with that dividend? We want to have consistency. We want to have predictability. We want investors to feel that this is a secure aspect, a secure element in their portfolios. We don't want to reduce that regular dividend, and we don't want to suspend it. So this has to be like almost a casting stone feature of the company's return of capital policy. That's why it's set up at 3 cents Canadian per share. Now, that's not enough. That's not enough money to return to shareholders when copper prices are at, for example, today's levels. So what do we layer on top of that? We have been active on repurchasing shares because we feel that the company's share price is still an attractive investment for us to tap into, buy those shares and cancel those shares. So we've been very active on share repurchases, and we've canceled essentially 10% of our issued and outstanding shares in the last 2 years. And the last layer of that is a performance dividend. It's essentially a dividend that will reward shareholders for the performance of copper price. That dividend has nothing to do with with the regular dividend. It's a flexible dividend. It can be declared at any time for any amount. So that gives us the extra layer of flexibility to not keep idle cash on our balance sheet.
You've been paying down debt aggressively this last few years. What is your debt target and what do you want to reach that you're comfortable with in the long term?
Sure. Let me just tell you why we incurred debt in the first place. We incurred debt of 100 million US to finance the expansion of our plant to get us to the levels of production that we currently have. That debt is down to $27.5 million now. We have a good finance agreement in place. We're paying that out at a rate of 7 million per year for the next 3.5 years. So essentially, it's not a high level of debt to carry, and we're slowly but surely paying that off until we get to net zero debt in 3.5 years.
You put out production results yesterday for the fourth quarter, and you exceeded your guidance in 2022 for the third year in a row. Looking to the future, how should investors think about production growth versus free cash flow at Amerigo?
Look, our production in 2023, which we have guided for, is consistent with our actual production results in 21 and 22. So we are at that stage of maximum production, but very consistent production. The driver then for us is copper price, because copper price is the other factor that affects our revenue. For the same number of copper produced at higher copper prices, the revenue of the company is significantly accretive. Just to give an example, average copper price in 2022 was $4.01 for us. Today's copper price is $4.28. So you basically have there a significant revenue appreciation just in the basis of stronger copper prices. Now, what happens when copper prices are stronger? We do pay a higher royalty to El Teniente. We pay higher income taxes, as every corporation does. But the rest of the operating cash that is generated is all free cash flow to our shareholders.
Aurora, while we're lucky enough to have you here in person, I wanted to ask you if you have any opinions on how important electric vehicles and renewable storage will be to the copper supply-demand balance and prices through the rest of this decade. Are they truly a game changer?
Well, everything adds up. I mean, if you use very easy to remember numbers, electric cars use 3 times more than conventional cars. Vehicles such as trucks or buses use 15 times more copper than a regular bus. So you just add that up. But it's not only the cars; it's the charging battery, the charging stations, the storage of facilities. Energy storage facilities, secure power grids. So the demand for copper on the back of these changes, structural changes that we're seeing is significant. Depending on who you want to read, you can look at supply gap estimates of 4.7 to 10 million tons of copper per year. And that number, just for the people that are not that familiar with the industry, represents 50% of current copper production. So those are huge numbers that we're looking at, and this is we're in a crossroads, a significant crossroads for the copper market.
Those were some great insights. Thanks, Aurora.